Thanks for joining us on another For Investors, By Investors South Bay podcast. As always, we are proud to be your all-education real estate investment resource without any kind of sales pitch. If you would like to attend one of our meetings in person, we meet the second Wednesday of the month at The Point in El Segundo. You can RSVP at forinvestorsbyinvestors.com/South Bay. To find more investment resources such as blogs and podcasts from other FIBI groups, go to forinvestorsbyinvestors.com and search our library. Now, on to the podcast.
Thank you guys very much for joining us. We really appreciate it. FIBI stands for For Investors by Investors, and it was put together by a couple of full-time investors that were tired of getting the sales pitch each time, the boot camps and the book and tape sets and things like that, and wanted to go to a place where you're not going to get pitched that kind of stuff and really just get education without that kind of sales pitch involved. And really the networking is really where it's all about here. You can't do this business without each other. It's extremely important to have that kind of network. And I swear, Dave, this has been like the best place to get referrals. And I was telling you earlier, like what I first started doing in the beginning here was going to 4 networking events a week in the beginning of my career, and it really took off like crazy with those amount of contacts. And so going to these things, getting educated, meeting the people in the room consistently, where you develop that good relationship with people, I think is extremely valuable down the line. So that being said, For Investors by Investors, we have multiple chapters throughout Southern California. I run the Long Beach one, soon to be the Cerritos and Long Beach event, because we're going to be moving the venue over to the Cerritos Library pretty soon, which is actually a pretty amazing library. I don't know if anybody's seen it. When I first thought it, I was like, library? But it's like a work of art. But anyways, so that being said, we also have this group, which Dave and I run, and it's more of a panel type discussion. Christina, hold your hand up. Thank you. She runs the FIBI Pasadena, has some great speakers up there, lots of education. We have the FIBI Orange County also. And so, all these different clubs throughout Southern California all have the same mentality where it's education first, networking, and helping each other develop this business with each other's resources. So that being said, Dave, I'm going to let you turn it over. We have a couple of sponsors here. We're a nonprofit, so we don't really make any money at doing this stuff. And we have on some different sponsors that help us out along the way. So,
thank you, Matt. How you guys doing tonight? Thank you. Thank you for coming. Welcome. So if you've never been to a FIBI event before, we always get asked the question, like, how do you make an investment in FIBI? And we always tell people, you don't invest with FIBI. That's not what we're about. We're about networking. We're about education. But I also tell people every deal I've ever done in real estate, somehow, some way, FIBI's connected, right? I met a person, especially these 3 guys. We've all met through FIBI, right? That's how we all got connected. So that's what you're here for. The education's great, but really you're here to meet people. And if you meet the right people, that's when you can, change however your investing career is going. As Matt mentioned, we all just got back from Las Vegas, and there's a certain amount of stories we can tell with microphones and live streams and podcasts. So if you're interested in the good stuff, I recommend FIBI After Dark. I did write that in. After we're done here at 9 o'clock or soon after 9 o'clock, we've got to clear out of the space, and we all go over to North Italia. We have the whole patio rented out. There'll be food out there, a cash bar. So as you're here and you hear what other people say, other questions other people ask, remember that you're here to meet people. And that's the spot where you can meet them after the meeting and get a chance to talk to them, exchange cards, talk to all of us, get our information as well. We do have some sponsors that we want to thank. Is Jeff here? UDirect IRA? So UDirect IRA is a self-directed IRA firm. They do really good work. New Western Acquisitions is a sponsor of ours. They do some serious wholesaling, some great technology. The Note Assistant program is here.
You want to tell us there's a Note Lab coming up too, right?
Yes, there's a Note Lab. It's like a weekend workshop. It's hands-on, intensive to learn about non-performing first position notes.
I went to this Note Lab and it was actually pretty quality. There was a lot of great information there, so that's why I'm please let people know about it. There's some flyers in the back if people are interested, but I felt like it was a great way to educate yourself on notes, which I think is super important, a great strategy to use. So.
Well, I mean, doesn't everything we touch deal with a note somehow, some way? I mean, it's every deal in real estate has a note in it. So learning how notes work, even if you don't want to invest in notes, I think is super valuable in your real estate career. Spira Woodward is a local attorney firm. They're real estate attorneys, business attorneys. They do great work. And then Walker and Dunlop is a commercial lender. So they give us money, so you guys don't have to give us that much money, right? That's why it's only $20-25 to come. In June, we're doing a fun panel. Some of you guys have been here before. We've done a fix and flip panel. We've had a couple of husband and wife teams. Next month, we've got 3 husband and wife teams, and the topic is how to flip houses and not ruin your marriage. Wow. That's awesome. It's good. Matt wrote that, yeah. So that should be funny. Talk about some inside jokes. I'm sure next month we'll have all kinds of inside jokes. The last thing before we do some introductions here is we are not attorneys. We are not financial advisors. Matt is a CPA. Are you actually?
Where's the joke? Bring it. Come on.
I've got 3 to pick from.
Which one? I told him that I'm 132nd Cherokee Indian today. I'm like waiting for that to come out. Like, where's that? He's like, your complexion doesn't match.
No, I'm saving that one for Vegas stories. Yeah. So Matt's a CPA, but other than that, we're not here to give you advice. We're here to give you our opinion, our perspective as investors. If you have questions about your real estate investing, we recommend you consult a professional. And if you need a recommendation, let us know. Okay, so with that...
Before you start, you want to talk about the Sam Manuel networking event?
Oh, yeah, that's right.
Thank you, yes. So is it June the 6th?
Yeah.
So June the 6th, we're doing our annual, our semi-annual networking event where all the different FIBI panels promote one big event. There's no presentation. It's just a networking event. And this year we're doing it at Blue Water Grill down here in Redondo Beach. So it's South Bay local. It's up on meetup.com. So check it out. Thank you.
Yeah, is this working, by the way? Is this working? Yes? Yeah. So for those of you who have not been to our semi-annual networking event, we usually get about 200 to 300 RSVPs. So we probably have about 100 to 200 people. So if you've not been to it and you want to do networking with a lot of people come from all different parts of SoCal for it. So definitely come join us if you're around, especially because it's so close by. So.
By the way, one other thing, we have a range of people that come to FIBI, like looking in the room. We've never had 2 children before come to a FIBI meeting. And not only do we have 1 today, we have 2. And I was going to give an award for who was youngest. And the 8-year-old loses to the 6-year-old. What are the only time, any other meeting you ever would have come to, you would have been the youngest person, but now you're the 2nd youngest person. So thank you for coming to FIBI. Okay. Hunter, say hi.
How's it going, everyone? So I'm Hunter Thompson, not the writer. I'm the Hunter Thompson, just want to get out in front of that. I'm the owner of a private equity company that helps people invest in commercial real estate. Right now we're focused on mobile home parks and self-storage, but I've invested in virtually every type of real estate that exists except for assisted living. So if you know an assisted living operator, make sure to get me in touch with them. This is interesting. I've been on a couple of panels before. Usually there's a big discrepancy in the perspective people have on investing. All of us are very close, and we've all influenced each other significantly over the last several years. So we all definitely do have different perspective, but I'm definitely interested to kind of share the stage with these guys and talk about some of the details of our strategies. So thanks again.
Thank you. Jeremy?
So, hey guys, everyone. My name is Jeremy Roll. By the way, for those of you who have not been to FIBI or don't know all of us, this is a very unusual panel because we're all really good friends, so we may say some really silly things while we're here. Usually it's not like that. But anyway, we are all serious investors, and we appreciate you coming tonight. I'm actually one of the 2 co-founders of FIBI back in 2007, and I'm a full-time, I call myself a passive cash flow investor, in that I invest in managed or passive opportunities that are typically lower risk, cash flow focused, mostly in commercial real estate, similar to actually a lot of these guys here. I also manage an investor group that I built up myself of over 1,000 investors who are looking for similar passive opportunities to myself. And what else can I tell you? I'm actually an advisor for one of the crowdfunding sites in the U.S. called Realty Mogul. Some of you may have heard of that. I've been an advisor with them actually since before they launched. And just want to thank everyone for coming.
Thank you. Tuna?
My name is Tuna. I had this can resume thing, but I was thinking on the drive here 10 years ago today, I was actually 1 year away from moving back to my parents' house. And 10 years ago, I was actually telling my parents I was going to retire them. That's how bad it is. So if you were to tell me 10 years ago I would be on this panel today talking about how to retire, I would have probably told you to go F yourself, pardon my French. But what I'm trying to say here is not so much to make fun of myself or anything, it's just that anyone can actually do it. And that's from a guy that's been failing, and moving back to their parents' house 1 year before they started real estate. And here we are today. So,
and just to put in perspective, and this is where it starts. So I was doing work today, texted him about the meeting tonight. He's like, oh, I just finished boxing. It was like 12 or 1 o'clock in the afternoon. So I'm still working and he's still working, but he's actually really retired. So.
What time does he start? Around 12? Is 10 o'clock? Yeah. Perfect.
Thank you, man. And Tuna, you don't have to make fun of yourself. We'll do that for you, dude. Don't worry about it. So, we love you enough to do that, dude. So, my name is Matthew Owens. I am a California licensed CPA. I don't do taxes anymore, but I will help you guys with your stuff if you guys need some advice. I am a full-time real estate investor. I flip about 10 houses a month. We've flipped over 600 now in the last 10 years. We own a real estate brokerage out of state. We do a lot of lending to other flippers in different markets around the country. We do a short-term rental business. We do value-add multifamilies, and basically just love doing real estate and continue to do it consistently and find new ways of making money with different people. So it's a lot more fun than doing the accounting stuff and wanting to bang my head against the computer doing audits. That's lots of fun, but the accounting skill set can really work in your advantage in real estate. So
12 years ago, I worked in an ad agency, flying around the country all the time, and I was tired of being on an airplane, and being in real estate is how I got out of corporate life. And I think it's part of what Matt and I talked about. Really, everyone here has created a life in real estate, right? And we none of us have jobs, but we're always working except for Tuna. Jeremy's probably the busiest retired guy in the world. When you schedule time with Jeremy, you usually schedule it in 7-minute increments, which is like, I think, even less than Warren Buffett schedules. Is that right? So anyway, my name is Davey Coe, and I got into real estate, fixing and flipping. I'm an agent here at Keller Williams Beach Cities. Welcome to our office. I started fixing and flipping, doing single-family homes. I've gotten involved in doing some development where we have a project in North Hollywood to build 37 single-family homes. Building in LA is terribly interesting and terribly risky right now, but it's been a huge learning lesson. So we're super excited that you guys are here, and I guess the first question we want to talk about is everyone has a different vision for what freedom means or what retirement means. Why don't each of you give us what you see as your freedom and your financial freedom, what you see as your, retirement here with real estate?
Sure. So, I have been kind of an entrepreneur from a very, very young age, and a lot of that was just having to do with, wanting to create my own schedule. In real estate, I think we're really frequently looking at comps to kind of determine the ceiling of your income, in the sense of you want to look at your comparable market comps to dictate how much you can raise rents, for example. But I have always tried to be in a situation where there is no comp when it comes to entrepreneurship. There's no ceiling, right? There's just infinite amount of money that you can acquire, infinite amount of influence you can acquire. And that's something I was always really drawn to. So when it comes to real estate, I graduated college right around when the collapse happened, moved out to California, and these networking events were very, very small at the time. So the beginning of my business was going to very many, very small networking events. And Matt mentioned earlier, 3 to 5 a week, anywhere within 2.5 hours of Los Angeles. If you were having a networking event, I was there. And so that was really the beginning of my business. But a lot of the people that I was meeting at these very small networking events, because a lot of the market had been wiped out, I didn't know it at the time, they ended up being some of the most influential investors in the state and people that really were able to weather that storm. And so as the market continued to correct, and as my learning as an investor continued to get better and better, I really started to fall in love with the business as a whole. So I certainly work harder than I ever did previously. but I love it. And that really is the freedom, the personal freedom that real estate has granted me because of that, because the combination of the passive cash flow, the tax deference, and the fact that you're able to get really inexpensive leverage. I mean, these are the things we've heard all the time. It doesn't get old, especially in the United States, the way that the tax laws are written, just incredibly favorable. So, for me, the freedom is barely being able to sleep at night, knowing I'm well protected to the downside. And so that's really how my portfolio is set up. That's why I focus on mobile home parks and self-storage. That's why I focus on passive investments in which I can rely on someone else's expertise. I know where my expertise is, and it doesn't have to do with on-site management. So I identify some of the best in class in those in the asset classes that I think are favorable, leverage their expertise for that, and focus on dealing with investors, which is what I love to do. So we can go into details about more of that, but that's kind of the short pitch.
I love entrepreneurship because that's really at heart. You kind of have to be a big part entrepreneur to be in real estate and be free of whatever you're trying to be free from. All of us have some level of entrepreneurship in us, and part of being an entrepreneur is taking risk. You have to take calculated risks, but you have to be able to learn to jump and then learn how to fly sometimes. You can't, it's hard to edge your way in this thing. You got to just jump and get all in.
Yeah. How many people here are entrepreneurs right now, or do they, and how many people still work for someone else for that side income right now? Okay, awesome. It's I can tell you, coming from both sides of things, that it's when you start working for yourself and building assets,
When you start building assets that create money for you, whether you're working for it, just like the book the Rich Dad Poor Dad book says, you start to see things a little bit differently from working. My blinders were on working for someone else. But when you start to actually find new ways of making money for yourself, it's super empowering. And you can't just go quit your job because if you need the income and things like that, of course, but start developing these side income streams that are passive to get you to that point to where now that passive income covers your job to replace it. Not everybody can just bounce and jump ship and do that. You can maybe do it when you're younger, but if you have obligations, it gets harder to do that. So slowly build on this stuff to get there and educate yourself every step of the way on all these different tools that they're about to talk about and all these different strategies, because those are what's going to get you to true financial freedom. That education piece that you're lacking on all these different tools and the resources that are there is what's going to get you there.
So for me, I spent many years in the corporate world very frustrated, and this goes back years ago. I really felt like I was never maximizing my potential. I didn't really know how to do it, but I knew that was a big challenge for me. And my last two jobs were like at Disney headquarters and Toyota headquarters here. It's like huge companies, right, where I'm like one of tens of thousands of people. And the way that I found financial freedom, like what that means for me, is really cash flow completely changed my life, short of sounding like an infomercial. It really did. I basically rotated my money out of stocks and bonds starting in 2002 after the dot-com crash into cash flow. And it took me a whole number of years, but eventually the cash flow got me out of the corporate world. So it's funny because now I've been out for like 11 years full time, and I like to tell people my primary goal is to find more opportunities to reinvest my cash flow so I can continue my cash flow stream so I never have to go back to the corporate world. So really cash flow has completely changed my life. And what I've also learned is that I really look for predictable cash flow for that reason, right? Because it's kind of like Hunter. I want to go to sleep tonight, wake up tomorrow, and really not much has changed in that I want to be able to get the cash flow that I thought was coming because I live off of it. So that's basically answering your question. Financial freedom for me was just all about cash flow, continues to be about cash flow, and all about the predictability of the cash flow.
Tuna.
So I can give you guys the boring answer or the fun answer, and the boring answer is, we'll get to the fun. So the boring answer is it's about $2 million, I think. $2 million or $10,000 a month, not counting your housing costs, because you're living in one of the most expensive cities in California. So that is the goal. So the way to get there, for me in my head back in the day, was to buy $1 million worth of property. That was the goal, to buy $1 million worth of property. The second goal was to have $1 million in equity. That was the next step. And then finally, from there, the cash flow allowed me to get to that point. But I think $2 million is really good. To put in perspective, you make a 2% return on $2 million, that's $40,000. It's a huge amount of money. when you start trying to invest with only like $50,000 or $10,000, you're not going to move the market. You're not going to be able to be financially free with such a little amount of money. And I'll get into like how all this works. Remember, I was living with my parents, no money, no job, no nothing. I was able to do it. When I realized financial freedom actually happened just about a year ago. So my mom was diagnosed with cancer, and just after that, my dad was diagnosed with lung cancer. That was when I knew I had financial freedom, because I was able to, the last 365 days or so, I was able to just be with them and not even worry about the cash flow. Every single month, I had money in the bank, paying for my parents, paying for myself. That is financial freedom. Being able to wake up whenever you want, sleep 8 to 9 hours a day, being able to go to the movies with your friends, spend $200 because you guys have this recliner seats and you have a waiter for the, that's financial freedom to me. It's not like the cars or the house or anything like that. It's literally just the little things in life. Being able to take care of your health.
How much did that gold chain cost you, dude?
Oh my goodness!
It seems like it's flashy.
That is it.
I don't know. It's not about the cars, but
he wore this chain in Vegas, and I asked him if it was real. He said it is. So anybody who wants to jump on him after, it's probably worth a lot of money.
I'm leaving, guys. Have a good day.
Love it. That's awesome to hear. So, it's interesting because we're all striving to be where Tuna is right now. Is to not have to work, and really I feel like we have a deal bug, it's like once you get hooked on a deal or strategy that you can see really making a lot of money and you can see where it can go from there, it's like real estate crack. You're just like, oh wow, there's another deal, get it, right away, and it's like, it's interesting because you guys have a little bit different perspective where you guys invest a lot for the passive aspect. Tuna, you actually were active as well when you were getting your equity and getting your cash flow. And I feel like myself, from the active aspect of things, my potential to be able to grab equity much faster and get to that point very quickly is substantial. At the same time, it takes a lot of time and a lot of systems and a lot more of my work up front to get those things to where they need to be. And you can go with a passive aspect of things, which, don't get me wrong, they invest passively, but they're not passive when it comes to due diligence and homework and vetting people and finding deals and all of that kind of stuff. But they choose to invest with passive operators, or being with active operators where they can be passive and rely on good people. The other strategy is to actually be the operator yourself, which I think for people starting out, it's a great strategy to try to be an operator yourself, because you understand when someone's full of crap or not on their financial assumptions. You understand what things can go wrong in a deal to know what to ask an operator if you're investing passively. A lot of times, I think people jump into passive investments without necessarily knowing how to do their homework correctly. And if they did a couple of deals themselves, or managed a property themselves, or did any of those types of active opportunities, a lot of people would, their education level and their questions would get a lot better. And I think it's important to do both, because you can get that experience, get those equity gains really quick on flips, on multifamilies, where you can be the operator and not have to have the capital as much yourself, maybe some of it yourself, to get those deals done. But at the end of the day, the goal is to take your money after you've made that actively and put it into passive stuff. So
it's actually why I have a real estate license. You talk about being active, you're constantly in deals. Yeah. It's a great way to get exposed to different kinds of deals as well. So finding a job in real estate is another great way to get, exposure and deal flow. So let's talk about systems, and actually I'm going to send it back to you, Tuna. So what you did build, right? You did, Matt's right. You took it from where you were to where you are now. Talk about what was your primary strategy and how you got to where you are right now.
So it's still actually the same strategy. I'm still buying real estate today, even in this market condition, and also still in California, but more in the Central Valley. So the way I start, or the way I look at things, is that a lot of things are free. A lot of things are free to do. And I'll give you an example how I really got started, and I still do this process today. I go to Zillow.com. That's free. Okay, I start searching for properties. That is free. On all those properties, there tends to be a realtor or broker attached to that. Their number is there. Calling them is also free. talking to the realtor, having them explain to you about the property and showing you the in and out of the property, that's also free. So all this stuff is free. I didn't lose anything here. Whether you're going to do real estate or not, you didn't lose anything by just doing all this free stuff. Here's the other part that's crazy. Making an offer to buy a property, also free. Like, all this is free. And it doesn't get real until you get like a counter offer or the seller decides to accept your offer. That's when it actually becomes a real thing. All that before that was free. And I spent about 6 months learning about the area just by talking to realtors, asking them questions, seeing what they rent for, seeing the area, seeing the properties, and seeing what a good deal might be for me. Because the thing I was looking for was cash flow. So hopefully that kind of answers a little bit about it, but I can go in more detail if you guys want to.
No, that's great. I mean, but you're still doing that today? Are you still on Zillow today?
I'm still buying properties today. Specifically, the only areas I'm really looking at now is Palmdale, Lancaster, Bakersfield, and a little bit of Riverside. The reason why I look at Bakersfield and things like that is just, gosh, you can buy a property that's still cash flow today in a really, really good area of Bakersfield. And that's more important to me nowadays because everyone's talking about, okay, we might be at the height of the market, you may be buying it wrong, you may lose all your money, but if you're buying in a really, really good part of the town and you're not leveraging too much, you can ride it out. You can totally ride it out. Like, I'm buying properties that for the last 3 years, I had no vacancy in that part of the town. It's just everyone wants to stay in those cities, in that part of the city.
I think it's interesting. Actually, Bruce spoke at Christina's club last month, right? And the reason we weren't there is because we were in Vegas. And one of the things that Bruce talked about is that for this past 10 years, most people are buying because of cash flow versus in 04, 05, 06, everyone was buying because of appreciation. They just thought the market was going to keep going, and it didn't, and it radically went the other way. And it's one of the things that Bruce sees that's different about this market than what was, in 2005, 6, 7. For the most part, lending has been more reasonable, expectations have been more reasonable, and you can still find deals if you know where to look. So Jeremy, I think it's interesting how you built Roll Investment Group and how you built FIBI and how those things kind of intertwine. Can you talk about that a little bit?
Yeah, I'll try and keep it short. There's a lot to cover. So first thing, just so you know, is that for those of you who are trying to figure out a way out of the corporate world or trying to figure out how to build up cash flow, like when I started back in 2002 and I said I rotated my money out of stocks and bonds into cash flow, my big problem was that, just quick numbers like Tuna was talking about, if you take 10% cash flow, you have $1 million, and that's $100,000, and when you're young without a family and everything, that's a great number. The challenge is that I didn't have $1 million. So what I did was I actually kind of end up with a blend of kind of low risk cash flow and what I would consider higher risk cash flow. I'll explain what I did actually. So one example is like I had a friend who was starting a web hosting company, and I decided, look, he's a really good person to make a bet on. I was basically buying servers and leasing them to him. And he basically approached me at one point and said, I'm about to lease a server from a really small company because my company is small. It's a 28% interest rate, 3-year term. And if you run the numbers, that means that for every dollar that you lend out, you're getting 50 cents back every year. It's like 50% cash-on-cash return for 3 years. And if you can compound that number over many years, it really adds up very quickly. So, 60 leases later, that compounded a lot over a course of I think it was 8 years. So I was mixing that type of thing up, making a bet on the right people when I could with lower risk stuff. And then I eventually compounded enough money to be able to get out. Even when I got out originally, I was still at risk because I wasn't fully into lower risk deals. I had to kind of get out of them over several years, in terms of a cash flow balance. So, I just want to be clear, probably none of our stories is as straightforward as it may seem right now that we're sitting up here. So definitely, if you have the opportunity to be creative in terms of how you have to get out or what you have to consider, there's definitely could be some risk, but it might be worth taking if it's calculated. So that's kind of number one. Number two is, with Roll Investment Group. So I have an S Corp. It's called Roll Investment Group. I have some investments from it. I also built up an investor group. And, basically the whole investor group that I built up, which has about 1,300 investors now, has just been a product of networking. And it's just a bunch of investors who actually are looking for similar opportunities to me. And I send a couple deals out a year that I invest in. Most of the ones that I invest in are just for myself for many reasons. And so, it's really just a product of networking. So to answer your question, it just got built up over 16 years, and it sounds like a lot of investors, but when you do a lot of networking over time, it just kind of adds up. So it just, like anything else, if you have enough time on your side, you can do really great things and accomplish a lot of things. So that's what I call more like just I have time on my side, so it got big. As far as foreign investors by investors goes, basically, when I first started in 2002, my number one challenge was finding opportunities to invest in. And for those of you who are not familiar, on the passive side, I invest in something called syndications, which mostly are not allowed to be privately marketed. They have to be, not allowed to be publicly marketed. And so the challenge I had is, where do I find any of these if no one can publicly market them? You have to go network. So I started going to networking events in 2002 in LA, just like Hunter was at 3-4 a week for many years, and the biggest challenge was that a lot of them were sales pitches. And so when I finally, I would sit through a 2 or 3 hour sales pitch. In fact, I would bring work in the back of the room. Literally, I'd sit in the back row. I had my BlackBerry, which I still have, and I had work, like a folder.
The exact same BlackBerry.
Yeah, and I literally do have a BlackBerry. So, okay. But people don't know they still make these brand new. So this runs Android apps. That's my defense.
I think you're part of the 04% market share that they have.
I am,
you
yes.
And 3 other guys, right?
Yes.
Two of which are also Canadian?
Yes, I'm from Canada originally. So.
Refurbished is not new, dude.
I'll get you back to that. So, it was a new phone. So anyway.
By the way, we were sending text in Vegas back and forth, and we send a text, and we'll have pictures or we'll have emojis. Jeremy would get it; it'd be nothing but text. He had no idea what the hell was going on because he's got a BlackBerry from last century.
Please email me that photo because I cannot.
We eventually just kicked them off the text.
That's awesome.
The refurbished phone is not true. Those stories are true. So I would sit in the back row of a 2 or 3 hour sales pitch just to network with people at the end. I literally was doing work on my phone, emails. I had a folder of work, and I was not paying any attention to what was going on in the room.
Who's doing work right now? Raise your hand.
There you go.
Thank you.
So what happened is once I left the corporate world, I remember I was sitting in my first meeting after I left the corporate world, and I did not have work. And I was like, what do I do for 2 or 3 hours? This is not good. So that's when I realized, okay, now I've got time. I can actually start my own meetings where the core foundation is that we don't sell anything, right? And we just try to break even. And we actually lose money on FIBI every year, literally. I was just griping to Matt about that today. So long story short is that Foreign Investors by Investors just started off in two different coffee houses. I had to start it at a Starbucks in Westwood. We had 4 people show, including myself, the first meeting. And now we have over 25,000 registered users. And again, all it really comes down to is just a question of persistence and time. But I think that built up because people saw that we were for real without the sales pitch. They didn't really believe us at the beginning. And that just built up. And, when you come to one of our meetings, whether it's Christina running it or these guys running it now, the one thing you should know is that we're just adamant about no sales pitch. In fact, we've never expanded beyond really Southern California because we don't take on any chapter leaders unless we've known them for years, know they're really not going to pitch anything, know they're truly real estate experts that we can really count on. So we could have expanded all across the country, but that wouldn't make any sense because we're really careful. So that's how FIBI started. But, in the end of the day, my ability to continue my cash flow stream is really all about my network. I know we've been talking a lot about networking tonight, and the network that I was one of the 2 co-founders, so I'm a little lucky because I'm kind of the hub of the whole thing to start. So I built up a really big network as a result. And so from that network comes a ton of different opportunities. I have people, and in fact, the investor group that I have, the real big benefit I get from it is the fact that people keep me in mind, send me opportunities, because these are mostly privately marketed. How am I going to find them, right? So the networking effect is huge. I can trace back every deal I've invested into some type of networking thing. I met all these guys at FIBI. I've met some of you that are in the audience here or other networking events in LA. So I cannot stress that enough. If you're going to become a real estate investor, real estate is a team sport, and a lot of people don't really get that. But no matter which aspect of it you actually participate in, active, passive, it's all a team sport. So that's kind of a little bit of history behind FIBI.
Hunter, can you talk a little bit about your investment, the key elements of your investment strategy that have, helped you create financial freedom?
Yeah, absolutely. I want to kind of talk about, starting from the beginning, we'll work our way up to the current. So I started in about 2011, and really the goal was to cycle out of stocks and bonds and move into real estate. Most people had their big moment in 2008. For me, I was just really interested in financial assets at the time. So I saw this major collapse. I've always been countercyclical by nature. Was like, okay, there's going to be an opportunity in stocks. Let's take advantage of this. And was really on that train until about 2010, which is when the European debt crisis happened. It was very similar to what happened in 2008, but it was in Europe. And that's when I realized, I saw what was going on in my portfolio and realized that despite any kind of how much attention I paid, how much advantage I considered myself to have, which was pretty much zero at the time, I could not be uncorrelated with the German bond yields, right? They were all focusing on the German bond yield, saying if the rates went above 7%, the S&P 500 was going to collapse. And if it stayed below 7%, the S&P 500 is going to be fine. And I was like, how is it possible that something like this is playing any role in my financial well-being? And so really started investing passively. It was really turned on by mobile home parks for some of the reasons we can talk about later. Saw some of those investments, started making investments on my own. And I wanted to create my first syndication. So I sent a bunch of emails out to my friends and family, said that I had already had a couple years of success through a live event that was probably 20 people or so. And my goal, I needed to raise $500,000 to get this advantageous split so that I could get compensated for doing this, basically. And everyone I was talking to, was like, that's really easy achievable. You're going to be really happy with this event. You're going to clear $1 million your first go around. It's not going to be a problem. And I scraped and crawled for 300,000. 300,000. I wasn't even, I was about halfway there. So right at the end of the investment time. Thank you. I'm not a numbers guy. Just kidding. You
should have had a BlackBerry. That was the key. You didn't have the BlackBerry.
I didn't have that. So we had about 12 months to raise this capital. And I really only anticipated raising capital for the month that we had this live event. So right at the end of the capital raising time, we had another investor come in, or two investors come in and solved it, and we made it to $500,000. I got an email. I got 3 emails yesterday. All 3 of them were for more than 300,000. Just those emails. So what's happened in between then and now is a tremendous amount of work, and that's really why I'm up here right now. A lot of it had to do with I was chasing people that didn't have the same perspective as a lot of us have on real estate, in the sense that I was going out to people that didn't know about these investments and saying, you're never going to believe this, but you can get 18% returns in real estate. Here's the documents.
Oh, that's too risky. You can't do that.
They would be like, there's no way. I mean, even attorneys would say, there's no way that this is real. This has to be a Ponzi scheme. Anything in that range is unrealistic. So I was pounding my head trying to be like, why aren't these people jumping at this opportunity? Because I was trying to completely paradigm shift was necessary for them to do this. So instead of doing that, instead of hunting, I wanted to be someone that people came to that were already on that program. So I was just building up an infrastructure that allowed people to do that. Part of that is I'm the host of a podcast which talks about commercial real estate. There's a lot of podcasts out there. The goal of mine is to be slightly more sophisticated than some of the other podcasts out there. So we get really sophisticated investors. They hear the content. They hear some of the people that are in my network, and they want to invest. And so that was really the paradigm shift, and that's when things started to really change. Here you go.
Yeah, I'm glad you mentioned it. I was going to actually tell people that he does a great podcast. It's definitely worth following. Again, it's networking, it's learning, it's a great way to learn. And similar to how you use FIBI, you're kind of using your podcast to build your network, right? It's all about building a network. So, yeah.
Cool. So, all of this is obviously extremely important for financial freedom, understanding how you guys got there. And it's kind of cool to see, all of you guys started without anything and built it, but it took a lot of education and work to get there. You've been building, all of you guys have been building this for a while now. What do you think, what do you guys attribute, what kind of education do you guys attribute to your success in doing this? Is it strictly the relationships and understanding what the needs of other people are? Is it specific education with regard to deal flow and understanding how to analyze these and the risks there? What are the different things that you think are important for a new investor to start to learn about to be able to be successful? Hunter, can you start with this one and we'll go back the other way?
Yeah, so I mean, it's a combination of things. I think we mentioned earlier about entrepreneurship and real estate, so it's a combination of those, and you don't want to be too heavily on either side of those. And if you do, then you need to make sure that you have a partner that handles the other one, right? So if you're really interested in exclusively networking and you don't really want to know the details of the real estate itself, that's okay, you can focus on that, but you really need to get a partner that is the complete operational guy. And so, if you haven't been thinking about that dichotomy, those skill sets are not necessarily the same. If you're really good at writing ebooks, that doesn't mean you're really good at underwriting real estate, right? So, and that's something people deal with a lot. Can you repeat the question one more time?
It's basically what types of education do you think the people in the audience should be getting?
Thank you. So,
Hunter's still a little hungover from Vegas.
You're looking at these guys up here. Really significantly impacted my learning at that was very, very significant. FIBI as a whole probably responsible for 80% of what I know about real estate. David Coe and I, the beginning of our relationship was really me just calling him and asking him about retirement account investing stuff, which he would call me in between houses, right? So I wasn't worthy of getting in his scheduler, but he would just ping me to be like, a Roth IRA is the one where you don't pay taxes after you sell the property. But now after all now we have partnered together on deals before, right? So that's kind of, that's how it worked.
That's awesome. I remember first meeting Hunter walking down, I think, the street, and we're at some networking event, and we're walking down the street, and he's talking to me, and I'm like, let me go talk to this other guy with money over here. I don't need to talk to this guy over here. But that being said, thanks. I appreciate that. Now that you have money, I can talk to you again, so it's perfect.
Here we are. What do you know?
Yeah, we'll go on vacation too, so... Jeremy, what is your thoughts about the type of education from your standpoint that has helped you to kind of compound your growth to the next level to where you're at today?
Yeah, so I would say, given that I invest passively, there's kind of two keys to that. One is you definitely need to be able to analyze an opportunity. And the way that I learn, I actually invest across, I'm actually in over 70 different LLCs right now. I've been in over 100 over time. And I invest across all different types of commercial and residential real estate. And I've learned a lot, actually, honestly, by going to a lot of meetings and actually listening to panels, not just at FIBI, but many other meetings in LA. There's a lot of good ones. But I've also learned a lot through what I call opportunity exposure, which is a lot easier to do today than it used to be. So on the passive side, if you're an accredited investor, which is meaning a certain amount of income or a certain amount of net worth, you can log on to some of the crowdfunding sites, for example, as an accredited investor, say you want to learn about apartments, you can go download 20 or 30 apartment deals in your pajamas in an hour and read them all. And you can compare them, look at the fees, look at the returns, and learn from them. And the way I had to do it back in 2002 was I actually go to these meetings, find individual apartment deals, and actually look at them. I mean, think about the difference, right? It took infinitely more work, but that's basically what I did. So half of the key for me is being able to analyze an opportunity, which I learned over time, through opportunity exposure and just learning, coming to a lot of meetings and learning. The other half is every time I invest, I make a bet on a person. And in my opinion, actually, who you're making a bet on is more important than the actual asset. To me, the asset is like the second piece. It's like when you invest in a startup, everyone gets really enamored by an idea or a concept. But if you have enough experience, you learn that greatest concept, if it wasn't executed by the right people, it didn't matter. And vice versa, to be honest. So it's the same thing when you're investing passively in real estate. You got to make a bet on good people. And so half of my job is to figure out who am I making a bet on. Am I making a bet on the right people? And kind of what I learned to do over the years is if you're reading like a 40-page summary, you've got to read between the lines. You've got to see, is this person conservative, using conservative assumptions, trying to build long-term relations with investors, looking to under-promise, over-deliver, using conservative numbers. In other words, the numbers could be better, but they're making them look worse just so they can actually overperform so that they can build long-term relationships with an investor, or are they trying to make the numbers look really good, attract a random investor here and there, and then just move on to the next deal and just raise that money. And so you've got to basically, I used to ask a ton of questions, and sometimes the questions don't even matter. It's how they answer and kind of listening to the way they answer and determining if they're conservative or not. That will lead me to decide if I want to invest with them. Another thing I always do is background checks, which I've said this for years, but I just don't find enough investors do background checks, and it's definitely saved me a whole number of times over the years.
By the way, if I can interject, Hunter and I, we've co-invested in a couple of things, and we had Jeremy look at one of our deals and look at our docs. How long did we spend getting all of Jeremy's comments in on our doc?
We spent a tremendous amount of time, and that was probably the least of the entire process, right? So that was like the documents, because it's much more about the person. All the due diligence is really focused on other things, and the documents are really least important, because the only time that those are important is when you sue someone. So with that in mind, we still took a lot of time.
It took a lot of time, but the attention to detail that he had, asking his questions, a lot of times it was a learning experience, when you really paid attention like that and asked a lot of great questions. And what I got from that experience was that Jeremy asked really good questions, right? And the better questions you ask, the better answers you're going to get. So that was one of the things that I think you did better than anyone else I've ever met.
Yeah, no, I appreciate that. But what's interesting to note about that is that if I'm asking questions to somebody, and I've really only learned the questions to ask because I've got 16 years behind me, right? So again, it's anything else, it's just a question of time. You can become an expert if you put enough time into something. But what I've learned is that, if you ask good questions and you're not getting good answers, you're clearly learning that's not the person you want to make a bet on, right? So that's an important aspect of it, obviously. So bottom line for me as a passive investor is A, who I'm making a bet on, and then B, do I like the asset that I'm actually going to make a bet on? So that's really what I focus on every time I look at a new opportunity.
And what are you doing typically when, as far as the due diligence on the actual opportunity? What are some of the key things that you look at? Say it's a multifamily building you're going to invest in, because I know each one is a little different. But say you were going to look at a multifamily, what are some of the key things you're going to look at initially? You talked about the operator, the background checks, the assumptions, that type of aspect. But on the actual property, what are some of the things that you're trying to look at to see if it's being conservative, or the assumptions are right or wrong, or the main important factors associated with that, maybe the debt piece, all of those aspects?
Okay. This is going to take a half an hour.
I need 3 bullets.
Yeah. No, I'll just really quickly spit out a few of the important things. So you want to look at the rent increase assumptions, or the revenue increase assumptions, the expense increase assumptions. And the first way somebody can make a deal look better than it is let's say they choose a 3% inflation on income and a 2% inflation on expenses, and there's a 1% gap, which compounds over 10 years. All of a sudden, it's actually a lot better than it looks. The question is, why is it that income is inflating quicker than your expenses, right? If everything inflates in society. So if somebody says to me, well, this is a really hot market and things are going quickly, well, are they thinking what's happening in 7 years from now and not in 1 year from now, right? So that's not the greatest answer. So you definitely want to take a look at that. You're going to look at for multifamily, there's a standard expense ratio depending on the market. So if you're in a cold climate, you're going to have a certain expense ratio. If you're in a warmer climate, you may have a different expense ratio. If you're paying for utilities, you've got to factor that in. Taxes can vary by state and by locality. So you're going to want to look at all these things, but you can very at a quick glance look at an expense ratio. If you handed me an apartment deal right now of a certain type of apartment, of a certain size that I'm used to looking at, I could probably tell you if the expense ratio seems okay to start, and then you kind of got to look into the details, or if something's already out of whack. And one way they can make the numbers look better is if they assume expenses are going to be lower than they really are, right? So if you have an expense ratio of 25% of income, and I look at that deal, I'm going to know already there's something very wrong with this apartment deal, and the numbers are going to look better than they should. And the problem is that until you understand that as a passive investor, they can swindle you, right? So you've got to be very careful with that.
What are the things to really get educated about, basically?
Yeah, exactly. Some other stuff, you're going to want to look at the location. Is the economy growing? Is the population growing, right? I mean location down to the exact street. Matt invests a ton in Memphis. I've invested with him many different times. I've actually traveled to Memphis multiple times with Matt. You walk down one street, and it's perfectly fine. Literally 1 block over is not where you want to invest.
It's like downtown Long Beach, basically, if you give it an example. I mean, you're looking at, 6th Street and below is cool. 10th, 40th Street, you're in the hood, so it's not that far away, so it's kind of interesting.
Yeah, so you really got to be careful with the location, but you want to basically be in areas, let's say on a 10-year horizon, that are likely going to have population growth instead of stagnation or declines. You need to really understand the average household incomes where you are, and are you buying a Class A property that's got very expensive rents in a C location that can't afford those rents, or vice versa, or what's going on with the area? I mean, there's a lot of
net migration in tax state, no income tax states, all that kind of stuff.
I think and one thing we talk about, actually, the three of us exchange a lot of emails daily just about what's going on in the markets. And one thing I always point out is there is a ton of things happening in the next 10 years from a technology and change perspective. So just 3 topics we talk about all the time. Robots, which basically are going to displace jobs and already are, right? And what effect will that have on the property you're investing in and the market you're investing in? And the type of what effect will that have on the worker that's supposed to be paying you rent or the business that's going to be paying you rent in 5 or 10 years from now. Then
Do you guys not invite Matt on that because you don't want to hear his political rant?
Taxation stuff, dude. Taxation stuff.
If you're in the audience, you've never been to Matt's Facebook page. If you go to his Facebook page, you'll start to get a sense of, his pretty hardcore beliefs.
I can't help it.
Yeah.
I want the government to leave me alone.
Not the only one.
Yeah. So so where I lost track now where I was.
Making fun of me, that happens.
Right.
You're looking at population growth.
Thank you. Robots. We were on robots. So robots.
We were on robots and we started talking about Matt. It was natural.
Yeah. Robots. Robots, internet, and population getting older, right? I mean, and then self-driving cars. Those 4 things alone, huge shifts happening in the next 10 years. And when I look at a retail strip center, what's that going to mean? If I look at an office building, what's that going to mean? If I look at a self-storage property, what's that going to mean? If I look at something in the Northeast, what does that mean? If I look at something in Florida, which is the #1 projected population growth for the next 10 years, what does that mean, right? So really, right now, there's a lot going on and a lot of changes happening. And when you invest passively or getting locked into a deal, you've got to think 5 or 10 years ahead to avoid the landmines. So you've really got to stay on top of the trends and really try to extrapolate what's going to happen. And don't just think about 1 or 2 years out. You've got to think 5 or 10 years out. So, I mean, those are just some we can go on about this for a long time, just some examples.
Let me just add to that before we go over to tuna, because Jeremy and I have a similar perspective on that, so I'll add just a couple things. So I'll see if I can remember these kind of in order, but for me, in order of importance, looking at passive investments, the sponsor is going to be the most important. For me, the on-site manager is going to be next. The loan will be then. The pro forma will be after that. There's one that starts with an M, I think, and then the property is last. And I'll remember that M1 in a second. But something that has really been important as prices have continued to increase is the capital stack, particularly the debt. So with real estate purchases, the vast majority of these purchases are debt, right? And so you got to think about the implications of that. Imagine if all of a sudden all of your investors were happy with 1 or 2% less annual return. What would that do to your business? Right? It would make things a lot easier on you, right? It would make prices go up. Well, that times 3 is what's happening with debt, because usually debt is 3 times the amount of what the equity is. So the implications of that are large. So especially in ancillary asset classes, meaning like non-multifamily asset classes, things like self-storage, for example, you need to be very careful about thinking about who the lender is in these properties, because when things go sideways, about 99% of the time that there's a horror story regarding real estate, it has to do with debt. All those stories in 2008, it was people that weren't able to refinance, people that weren't able to get a loan, et cetera. They weren't able to pay their debt service coverage ratio. So especially in something like self-storage, you need to have a lender that understands the asset class, that if something goes sideways, they understand how to value that. They understand when it would be appropriate for them to extend a loan, for example. And again, we can go on and on, but the one thing that I wanted to touch on when it comes to due diligence is that's something that's not taken very seriously. The loan to value is critical. It's the most important, but then there's also the debt service coverage ratio, or the length of time at which there's an interest-only portion. So with most commercial real estate deals, it's common to see 1 or 2 years of an interest-only portion. Now what this means is that it's the portion of the loan that the borrower is only paying the interest and not amortizing the loan down. That period is going to make the cash flow be higher during that from a cash flow perspective, because they're not paying that higher payment. So when it changes over, the cash flow will decrease. So some operators, they will have an extended interest-only period, and it'll make the deal look much more attractive than it actually is. But that doesn't paint the whole picture. If you see an extended interest-only portion, but the loan to value is quite low, it's basically they're moving these little tools around, and you want to see how conservative or aggressive they're being in an effort to really understand who you're making a bet on, which is why the sponsor is the most important. So when you're going through that list, looking at the on-site manager, looking at the loan, looking at the projections, reading between the line, it's not about the projections. It's about who is this person that you're about to entrust this money with.
It's the evidence of the person, right?
Yes, exactly.
They leave behind a trail on how they think based on how they run their numbers. Tuna, I mean, for you, I know you're looking at different kinds of asset. Most of yours have been like 2 to 4, actually 1 to 4 units, right? Yeah. So when you're getting these opportunities and you're making offers, like what are the types of things that you're curious about for the assets that you're buying?
Got it. Well, I'll get to that. So there's three things, and I'll get to that. So there's three things that I think is really important that we don't really all talk about, because you got to keep in mind everyone's different. I had no marketable skills. I had no skills before this. I didn't know anything about real estate. I didn't know how to run a business. I failed like 4 businesses before this happened. So you got to keep that in mind, in my perspective as well. So there's 3 things I think people should focus on. First is actually your own financial self, like what you make, right? So you can read all the personal finance books all you want. I'll give you guys the one-liner. Save half of it. That is the easiest way to get rich. Save half of it. If you can't even save half of it, save 1/3 of it at the very minimum. That is it. That's all personal finance 101. Number 2 is try to maximize your earnings. So it doesn't matter if you have a business, you work at a job. If your earnings are not that high, stop complaining. We're in this crazy market now. Like literally, I can make $30 an hour if I wanted to. I can go Lyft. I can go TaskRabbit.com. I can be an Uber driver. I can do deliveries. Have no ego. Just do it. Maximize your income as much as possible. So those are the 2 things. The third thing is if you're trying to do real estate, frankly, it's pretty easy. There's only 2 books I recommend. One is Rich Dad Poor Dad. It kind of gives you the whole idea of why you're doing real estate in the first place. So read that. Number 2 would be Retire Young, Retire Early by Rich Dad Poor Dad. Again, Robert Kiyosaki. That's the only 2 books. How I got started in real estate and what I look for, I literally read like 5 or 10 books at Barnes & Noble. And I didn't pay for any of this. I literally went to Barnes & Noble, read it for like 4 or 5 hours a day. It's the Asian, Jewish side of me. That's
Would you hide the book somewhere in the store?
I did. I'm not gonna lie, I did hide because sometimes you forget the page.
Flipping through used books in the store.
Yeah.
If there is even a bookstore anymore.
Barnes & Noble is just nicer. You feel good. You feel like you're gonna get rich one day.
Just for the record, Barnes & Noble equals Millennial Library.
Yes. Are they still around? I don't know.
The reason it's nicer in Barnes & Noble is because they're selling books there. It's not just luck.
Save 50% of your money. Don't listen to them. Save the money. Right? Remember that. The way it really works in real estate, the way I got in was obviously I had no cash flow. I had no income. So the way to retire was actually having monthly income, right? To kind of make income in real estate. So the way you think about real estate is very simple. You buy a property, and you only focus on like the very basic thing: principal, interest, tax, insurance, right? And that's all you need to really know in the very beginning. It's how much you're paying for the mortgage, how much you're paying for taxes, how much you're paying for insurance. Because real estate is really the only game where the tenants will pay for your taxes, pay for utilities, okay, pay for insurance, pay your PI, and it's like the American dream. You own a place that someone else is paying for, and then they give you extra money that you can put in your bank account. That is the greatest game in this world. And literally I was able to buy properties that gave me money, and I couldn't even buy my own house. And the way it worked was very simple. I started talking to friends and family. That's how I raised money. When back in the recession, it was unbelievably hard to get like financing. So I started talking to like my aunts and uncles to actually sponsor the loan. That's how I started, because I didn't have a 2-year tax return. I didn't have anything to show for it. But in return, I gave them a deal into the property. We shared cash flow from that. So very simply, if you have 4 units, this is a real example. You have 4 units, they pay you $800 a month. This is a very true example I bought. The very first 4 unit I bought was, I think, outside of San Francisco, $180,000 at that time. $180,000, 4 units pay $800 under market rent. There should be $1,000. $180,000 property, the mortgage was only like about $700 a month. So 1 unit took care of principal and interest and pretty much taxes. The other unit took care of repair and the maintenance, and the other 2 units, I kept that $2,000 in my pocket. That's the power of real estate. So it's simple math. It's literally, like I said, everything is free. Go to Zillow. It's free. Search the property. It is free. Like, this is free, guys. Stop overthinking things.
Yeah, it's true, and actually, I think it's funny, talking about being in Vegas, and it was the five of us, a couple other guys. These guys are some of the cheapest bastards you've ever met. And you would think the five of us in Vegas, it'd be this big deal. Like we sit there and talk for half an hour whether we should spend $100 versus $125. It's funny. Anyway, all right. So Tuna, you promised me you'd answer my question. You haven't answered it yet.
What's your question again?
Yeah, that's what I thought. Yeah, that's exactly what I thought. When you're looking at stuff out that you buy, what do you like to look at with the assets that you're looking to buy? What are the pieces of due diligence you do on your assets?
Okay, so very simply, if the stuff I'm looking at now is like single-family homes and up to like a fourplex, so still residential is mainly what I'm looking at. I mainly kind of focus nowadays, because where we are in the market and everything's expensive, I kind of focus on the best areas. And the easiest way to find that out is just calling property managers. Calling property managers, going to rentalmeter.com, going to Trulia, Redfin, and you really easily can learn what are the best streets, because these streets never go vacant. And if they do, they're instantly occupied again. So that's the very first thing I look for. Number two, nowadays in today's market, I try to leverage as little as possible, meaning I'll take 50% loan, max LTV. I'm kind of doing cash deals now. I'm trying to just avoid debt. This is bad, huh?
Keep going.
Okay. What I really look for is just properties that's going to give me cash flow, and it's very easy. You take all the monthly rents, you figure out the expenses, which is unbelievably easy, and then does it make sense? Does it make sense to you to buy this property? If it is, you do it. And the way you do that is either through your own funding, which you should save money, you should maximize your income, or you can raise money through friends and family like I did when I first got started. And that's pretty much as basic as I can try to get to.
I think it's important to understand, too, when you're looking at the due diligence on a specific project, whether you're being the operator or you're investing passively in those projects, understanding how to analyze market value, understanding how to analyze what your rents are, and what they should be, what market rents are. Understanding what kind of renovation that needs to be put into the property in order to get it up and running and being efficient to hit the cash flow goals you want it to hit or it should hit. Understanding the neighborhood to make sure that you're not buying in the hood and your tenant base is so low that you're not going to have a good collection rate and you're going to have more vacancies and vandalism and theft and tenant turnover and things like that. All of these different factors when you're going and starting off looking at a property need to be considered to be putting the numbers and compiling all the numbers and saying, how do I structure this deal and how am I going to get the capital to put it together? Am I going to come in and bring some private equity? Am I going to put my own capital in? What kind of bank financing is available for me? Does it need construction? And can I get a construction loan? And what does that term look like? And the interest rates look like? And what does it look like after you refinance that beginning loan if you have to? And what kind of risk are you taking on for having to refinance maybe 2-3 years down the line when the interest rates change and loans terms could possibly change? So all of these factors, you're going into analyzing a deal to understand what the total capital in looks like and how much debt you can borrow against it or you're even comfortable with in the first place. Because, Tuna, like he says, doesn't like to utilize debt. I'd rather use debt because I'm fine with the higher leverage as long as I'm comfortable enough with the amount of cash flow that I'm getting. I'd rather continue to compound that aspect. But then, having a bunch of paid off free and clear properties is a different mentality too. It changes your perspective of things. So, doing that homework, I think, is the most important thing you can do on your investments.
Can I add one thing? So when you look at a property, you can also think about what can you do to it to make it better. And I'll give you an example. One of the best ways that I'm able to get a lot more cash flow is I look for properties where I can build an additional bedroom. That is instant money. It is insane how much money you can get from a 2-bedroom and converting that to a 3-bedroom. And it's not so much the 3rd bedroom is that big. It's literally a dining table area that I turn into a bedroom. And that will instantly raise your rents almost 1/3 more. Another thing I look at is if you're buying properties in residential, a lot of times the landlord or yourself is paying for the water bill. So I look at landscaping and how to get rid of that or look at different ways of minimizing the water bill. If you're able to do that, that's instant income again. So those are kind of things that you should look for and try to be creative at to make more money.
Yeah, can you hand him your mic? You got a dead battery there. We'll fill it up. Yeah, the one thing I was going to say is we've all talked about different ways of analyzing the deal. One thing that I'll say is you have to take the deal and put it against yourself. Matt mentioned having a property that has maybe a high turnover. It may have great pro forma numbers, and you may understand that. But if you're making 18% on your money, but you hate dealing with tenants at 4 a.m, it's the wrong deal for you, right? Like you have to make sure that you take the deal and put it against your time, your risk level, how much patience you have. All that stuff has to matter. If it's a great deal on paper, but it doesn't fit what you want to accomplish and it doesn't fit you, then it's going to be a terrible deal. You'll have a horrible, ownership experience of that investment, and you'll be miserable the whole time. So I think that's also an important aspect of that. Okay. Yeah, I'll get a question. Sure.
I had a question for Tuna. Okay. So you like to own properties free and clear now. And you're investing in California, right?
Yes, I am. So the question is, I just want to repeat in this. So the question is, am I still buying in California today? And the answer is yes.
No, the question is, are you getting earthquake insurance?
Okay, so the question is...
That's a good
question. I'll tell you guys, I am not an advisor on this one. This is my own personal thoughts about this. I actually think about this every day. So the question is, do you get earthquake insurance? And I should be saying yes for all of them. Not really. Not really. I lose a little sleep on that, to tell you the truth. That's kind of one of the reasons why California, besides taxes and the liberal stuff that's going on in the court system. Other than that, I'm pretty happy with California. But to answer your question, not really.
Right.
Yeah.
So the courts, the government, and the land moving, everything else is good.
Everything else is amazing. This is heaven.
Got it. Okay. Cool. All right. So, by the way, anyone else have a question, feel free to raise your hand. Yeah, go ahead.
I have a question for Tuna as well. So walk us through your very first deal. You did a cash deal on the first one, all financed from your family, or your family just cash flowed your down payment, or how did that work?
Sure. So, so I invest, in the very beginning, I won't get too specific. I invested in Koreatown in Northern California, and my own self was in Central Valley, Bakersfield. So those are the 3 areas. I'm just going to focus on Bakersfield because it's just really like the ground's up. So the very first way I started this was that I looked on Zillow and I was like, holy shoot, the properties are cheaper than it costs to rebuild them. Like if there was a fire, it's like instant lottery ticket. You know what I mean? Like you're buying properties cheaper than it costs to rebuild. That was exciting. So I started talking to my family about possibly investing in real estate. And I show them like, hey, we're buying it cheaper than it costs to rebuild. So that is their equity already. Number 2, the rents are more than covering. So even if I'm really horrible at this, you can fire me, hire a property manager, and you should be pretty good. Like I was showing them different ways of how we get their money back first. And then the way it worked is that I had a person to sponsor the loan, to actually get the mortgage for me.
Is that because you didn't have a W-2 job at the
Exactly.
time? Financing?
Exactly.
Yeah, if you're not working, it's really hard to get money.
Especially during that time. Like during that time was my very first property. My aunt's friend sponsored the loan, and she almost gave up like 20 times. It took us 8 months to close the deal. And every 2 weeks, they were asking her for a bank, her W-2 to make sure she's still employed for some reason. This is 8 months of that. Like someone doing me a big favor in a way, you know. So the other part was raising the money. So I raised the money for the down payment, also that was through a family member as well. And when we bought the property, thank the Lord, it literally, all the tenants paid the first of the month, and I had cash flow, and I was able to show everyone, like, we're making money. And that's how it started. Like, I literally just did that, made sure it worked, set my sight on the next one, found a sponsor for both sides again, rinse and repeat. In the meantime, I'm saving 50% of that for myself. I'm actually saving more than that. Back in the day, I was saving 80% of my income while I was living with my parents.
Was that pre-tax or post-tax? Your pre-tax income or post-tax?
After tax income. And the great thing about real estate is that you get so much tax deductions. It's ridiculous. Like I don't know how to explain that. Like that's another American dream. Like you're getting properties that people pay for, and then on top of that, you get all these deductions and then you keep like the majority of your income.
By the way, saving 80% of your income is only something Tuna can do because he has unbelievable skills at saving money and getting deals on things. Let me tell you. I'm not exaggerating.
And getting deals in casinos also.
Yes.
Yeah.
I actually kind of just wanted to jump in on what Tuna's saying, because he's saying borrow from family members, which a lot of people were kind of adverse to that. Remember, you have not because you ask not. And I think every family has at least one person in the family that you would be willing to bet on. And I'm just going to say that because you are the people that are in this room, you're probably the one person in your family that your family would bet on, and you don't even realize it.
It's a great point, because the answer to a question you never ask is no, right?
Exactly.
Also, just to add to that real quick, there's probably people out there that are looking for money from you right now. So if you're in a position to give someone that opportunity and they're worth making a bet on, then I would definitely suggest doing that too, because that could really, really impact their lives significantly. So it's both sides of that spectrum.
And keep in mind too, when you guys are raising capital from family members and from close relatives, or anybody for that matter, realize that this is people's lives. This is their hours of their life that they spent raising this capital or getting this capital. And so if you lose it, then especially if it's family members, you better get that money back or find a way to build that back. And I think it's even especially with family, it's way more important to really, really communicate extremely well as to all the risks, everything you could possibly think of, because you have to live with this person for forever, or possibly have to live with them, you know? So be careful about that.
Good, Joe.
This is a little weird. I actually have a question for Matt. Okay. So you know the apartment property in Memphis that I think was the first one, was it 30 units?
Yeah.
Okay. How did you do the due diligence to make sure that was a decent neighborhood? Maybe you have to give a little bit of background there, but
So you call the police departments and look at
The question was.
Oh, sorry. The question was, how do you do the due diligence on a 30 unit, on one of the 30 units that I've done? And you start off with the crime rates, and you start to look at the crime in the area to see what kind of, what kind of crimes in that area, or if there's any issues. You start looking at, the surrounding neighborhoods, the houses, the tenant base in that area, what things rent for, because if they're too low of rents, then you know that it's not that high of a quality of an area, so you're looking at the tenant base, you're looking at those items, and then you're looking at the repairs. I mean, we bought that 30 unit for $780,000, and we were into it after rehab for $1.2 million. And we raised rents to over $18,000 a month and sold the building for $1.75, and we were into it for $1.2. And, it took about 2 years to do that building. But the due diligence initially, on the rehab, you're looking at all the exterior of this property. We had to spend $40,000 on the wrought iron staircases. We put, we put fencing in around the whole project. We put, gated access. It was, we put, lighting around the whole outside, security cameras.
How much did you spend due diligence on this deal?
Oh yeah, I mean, it was. We probably spent at least $5,000 to due diligence in the middle of the deal. I mean, you're getting a survey done, you're getting, an appraisal done as is to see what it looks like and what the potential is afterwards. You're getting inspections done, and this is a 360-page inspection report. I mean, I had to go through that in detail and come up with a rehab bid with my rehab manager. That alone was like a gigantic process, and we were off by at least $50,000 at least. Just things that we didn't know in the beginning. But we still hit a home run because we were able to be conservative on our rents and raise rents over time as we rehab those units. And so it took a lot, but at the same time, now we know, it costs us $7,000 a unit to rehab an interior of a unit out there. And, call it 10 if you're counting the exterior on a per unit basis, depending on size. And if it's a full rehab where you're doing plumbing and electrical and everything, you're talking about 30, so on a unit, to get that done correctly. So, question over here.
Question for Jeremy. Along the same lines about sources of information when you're doing due diligence. So, when you're looking at the area and where it's going, and you're looking at, say, I know that if you're looking at what the rents are, you might look at some online, sort of site. You just check the rent. But things on average household income, is that like census data, or how do you get some of that information that helps you studied the area.
Yeah, sure. So the question is, when I'm doing my due diligence, what online sources am I using, or what resources in general am I using, right? So what's interesting about the way that I invest is that while it's really important for me to verify separately, if you ask the operator or the manager, the person I'm making a bet on, for data they pulled, and they don't have a very good answer for you or not a lot of data, that's already telling you something. So step one is get the data they have. Now, the bigger outfits, like I invest 2 top 40 self-storage operators in the U.S. to give you an idea. They pay a lot of money to get access to very expensive databases that give you tens and tens and tens of pages about demographics and all types of stuff in a specific area. So what I would do is I would take that, and then I'll go as simple as like looking at the census data and looking at Wikipedia, which has its own sources, just because it's really, really easy, and they actually link off to various other pieces of data, just to cross-reference and make sure it looks right, so that you know that they haven't actually created this document. But there's only a few really large data sources that people can tap into for this stuff, and they're going to be of this very specific format. So it's typically, it's going to be above board. But, it's funny because my job is not to do the full due diligence that somebody would do on a property to determine if we should be buying it. My job is to do due diligence to make sure the person I'm making a bet on did all the due diligence, and then to kind of trust but verify and check some of the things that I got from them to make sure it actually adds up. Does that make sense?
Yes.
I can add to very similar strategies with that with reference to that. One of the sources I use is Esri.com. They have an online component which is just the census data that he's referring to that gives you a graphical representation of that. CoStar is another one. If you're trying to be a sponsor and you're trying to be the one that provides that information, it's about $2,500 a month, but that will give you really detailed analysis of a variety of different asset classes. But again, it's just good enough to get the data to cross-check whatever you're getting from the sponsor, right? Just to verify that they're not making it up or making something in PowerPoint, basically.
Yeah.
ESRI, and that one is about $200 a month. And that's probably the best if you're doing kind of similar to the passive stuff, because you're going to get all the census data. It's going to be very easy. It's going to be income. It's going to be daily traveled vehicles. That's something we haven't really talked about. We talked about demand a little bit. Now, it's definitely important to understand the market demographics, but then another step of that is making sure that demographics line up with the product type that you're trying to create. Right? So you could be in a great market in Texas for B-class multifamily, but if you're building an A-plus class multifamily units, it may not work. Similarly to that, I don't know how many of you guys are interested in investing in retail. It's obviously going through a transitional period, but that's a big one when it comes to matching the demand with the market. So if you have a lot of Gucci and Prada in a market that doesn't really substantiate that from a median household income basis, that's going to be a challenge for you. Just a quick note about retail, and this is something that I've gotten kind of from Jeremy, but the number of tenants is really important in all product types, but particularly in something like retail. So it's really important to get diversification in terms of the number of tenants, like 10 or 13, some investors like to see, and then also tenant bases that don't cannibalize each other, that really can help each other out. So like, for example, a karate and a pizza place kind of thing. And over the long term, those type of decisions will really benefit the business.
Yeah, I just want to point out that, another piece of the answer here is that, Hunter as a sponsor may spend $2,500 a month on CoStar, which is really good data. My money goes into the background check instead, just for example, right? So it's a different focus, but you want to make sure the sponsor's spending the money on their data, and you want to make sure you're spending the money on the right thing yourself. So
let's
quick question. So I think I've asked Joe already this question, and I don't want to tell you what his answer was, because I want your response to be unvarnished. So mobile home parks are a great investment, and there's a limited number of properties. Why isn't there more development of mobile home parks, new mobile home parks happening in the country?
Yeah, sure. So before we go into that, just so everyone's on the same page, just the big picture thesis of the mobile home park investment, because I don't know how many of you guys are familiar with it. So generally speaking, sorry, say it again. What was the question? Why they're not building new mobile home parks. So one of the reasons I like investing in mobile home parks is that you own the lot of the mobile home, and the homes are positioned on that lot. The tenants own the lot, and they pay you lot rent. Okay, so you're not really providing that much. The expense ratios because of that are very. Excuse me. They own the home, and you own the lot that it's positioned on. And because of that, you're in a really good position because you're not really offering much. Another part of the benefit is that you have this crazy demographic situation which is going on, which is that, there's 10,000 baby boomers hitting the age of retirement every year. Many of them
every day.
Oh, excuse me. I'm Miss. Thank you. I'm glad you're up here. Every day, many of them are relying on Social Security. Many of them are not in a position to actually pay for the average two-bedroom apartment in the U.S. The Social Security checks are averaging about $1,300 a month right now. The average two-bedroom apartment in a city averages about $1,200 a month. So they're getting squeezed. And there's all this demand, but the supply is literally shrinking every year because cities and municipalities are rezoning them to commercial assets in some variety. So now we've done that. The answer, I believe, is because, number one, there's been a big paradigm shift in what it means to be a mobile home park liver. Those were originally created as kind of an upscale community, as kind of a veteran housing program in the 60s and the 70s. And that mentality of that being, that was originally the suburbs, has really changed, obviously. So the cities are doing anything they can to rezone them for commercial assets, particularly multifamily or even residential, for a lot of reasons. I would certainly say that the fact that the taxes are much higher in those assets because the quality of the properties are much higher is the reason that's going to happen. I don't think it's going to happen anytime soon, which is unfortunate for people that are in affordable housing, but fortunate for people that are making that bet that I am.
Let's talk about diversification, right? Because I think it's important the fact that you guys have all you don't have an investment, you have investments. You all have portfolios that you're managing, you're overseeing, and one of the lines is you have to manage your managers the way you guys invest because none of you are actively managing the investments you're in. So talk about and Jeremy, why don't you go first on this one? Talk about how you oversee your investments, and how do you keep an eye on things, and more importantly, how do you find optimization, and what are the benefits of diversification in having a portfolio?
Okay.
That was a lot, wasn't it?
That is a lot. So as far as how I track everything, so I'm in over 70 different LLCs, so I've got a big spreadsheet. And then what I do is I basically go out about 10, 15 years, and whenever I go into a new opportunity, the first thing I do, because I'm really focused on the cash flow, right? So I'm all about the predictability of the cash flow, and that's the thing that really matters to me. So I'll go ahead and plug in the quarterly cash flow for the next 10 years into whatever I'm investing in, and I'll put in the start date that I expect to get the first check into the right, I actually go by month. And what I'll do is whenever I get a quarterly check from that opportunity, I'll compare it to what it was supposed to be, right? Or at least what it was projected to be originally. And my mentality, everyone's different, is if something's, plus or minus 10, 15%, maybe even 20%, I'm typically okay with that. If something's off by 50%, that's where I really look into it. And so for me, it's about being within a range, because a projection is like, let's be honest, like somebody projecting what I'm going to make in 8.5 years from now on a quarterly check of a certain property is probably not going to be exact in most cases. So I tend to give it a little bit of leeway, and especially because I'm managing so many different things, that I'd rather focus on the 5 things that are wrong and not worried about the extra 15 things that are off by like 10%, right, that are really wrong. So that's the way that I handle it. The other thing, too, is that I'm in a bit of a different position than a typical passive investor, because I do send things to my investor group, and by definition, anything I send to my group, I really try to stay on top of. So anything that I'm investing in that respect, I'm going to probably talk to the operator on average about once every 1 to 1 or 1.5 months. Which is actually, usually I'm used to getting a quarterly report every 3 months. So that means I'm talking to them more often than they're just sending a quarterly report. And so I try to stay on top of what's going on and just learn about what might be coming up. And I'll be the annoying person who will actually ask what's going on even like a month before a quarterly report's coming out. Where I'm sure the person on the other phone is dying to say, just give me a month and you'll see it in the quarterly report. But I tend to just try to build really long-term relations with a lot of these people so that I have an open line to them and I can really ask about that. So to me, that's a really important aspect too. I have the, I basically do this full time, so I'm able to spend time on all this stuff across all these different opportunities. As far as diversification itself, I am hyper-diversified, so I'm a little bit biased. But to me, I try to diversify across three different things typically. To me, it's asset classes, operators, and geographies. So I don't want to have too much in one basket of any of those. And that's the way that I look at it, just to really simplify it and make it quick.
Tuna, what about you? I mean, I know how do you consider yourself diversified, and then, more importantly, how do you keep an eye on all your investments?
So I'll talk about in the beginning and I'll talk about today, because there's two different tunas in this part. So in the very beginning, it was more of the active person, right? Like I'm buying real estate and trying to cash flow from it. I was not thinking about diversifying. I don't think you should be thinking about that until you have a lot of money. That's when it becomes a big deal. And the way you know you have a lot of money is because you start to realize, I want to kind of diversify out of this, like California earthquakes, for example. So you start meeting other operators and syndicators and things like that to invest in, because you don't really have as much knowledge in that field, for example. So when I look at diversifying, Jeremy makes a really good point, and Hunter's going to make a really good point. So there's not really much I can add to it, except if you want a simple rule, try to diversify into like 30, 40 investments of whatever capital you allocate to going passively. If you're active in the very beginning, just focus on cash flow. I think that's as long as you're picking the right location, the right streets to be on, that's the greatest part. If you really, really want to be diversified, then try to buy properties in 10 of the best cities in America. I guess that's another way to diversify.
How do you keep an eye on it, especially when you got multiple cities and multiple property managers? How do you do it?
So over time, I had to kind of build my own property management company. It was just a lot easier that way in California. The other stuff is a lot easier because if you're investing in syndications, for example, you get quarterly reports and you actually get to talk to them pretty easily. So you can either exchange emails or whatnot. I actually have just a simple Excel spreadsheet, and every quarter I kind of like write down my little thoughts on the investment and how it's doing. And that's basically it. And then just checking my bank accounts to make sure I deposit it correctly.
You have a question there? For Jeremy and Tuna, of your 100 investments you've done, how many of the syndicators give you online access to let you go run any report you want, anytime you want? And do you actually use it?
Repeat the question.
Yeah. Okay. So the question was, of all the investments I've ever made, how many of the managers, syndicators, give you access to run reports at any time on whatever data you want to try to crunch? The answer is really zero. It just doesn't work that way, because the responsibility of the operator is to provide you with a quarterly report based on the operating agreement, and that summarizes basically what's going on in the operations. Every single operator is going to be different, so if you've never invested with an operator before, you're going to want to take a look at a sample quarterly report, make sure you know what you're getting into. Some people are much better communicators than others, and some are much more thorough than others. But you don't have access into their own database, if that's what you mean. You won't be able to run a monthly report on their operating statement, for example. And the reason is because they want to focus on what they're really good at, which is operating that business, that piece of real estate. What they try to avoid, a lot of them are very happy to answer all the questions that you have, but they're not in the business of having you run a report like on their monthly statement and ask what happened this month on this line item. It's not down to that detail. They try to set a certain expectation of the cash flow and try to hit it, but it's too onerous for them, for every investor to have access to running their own internal reports. Does that make sense? Is that what you were asking?
That is what I was asking.
Okay. So that's just not the way. It may not be a good fit for you if that's what you're looking for, because it's not the way it works typically.
Let's go here.
So.
Go here. Go ahead.
Does making appreciation plays versus cash flow play a role for diversification for any of you, or is it all about cash flow?
Yeah, that's a good question. So the question was, do any of us diversify into beyond cash flow, let's say into more value add or development type opportunities, et cetera? We're all, I'm sure, going to be different. I'll answer really quickly. I am very heavily focused on cash flow. I actually have investments in startups, like a few. That's always like, I have to make a bet on this specific person. I don't want to let this person go. They're really awesome. I want to make a bet on this person. And that comes up very rarely. I have investments in ATM machines and other things that are outside of real estate, but 99% of my focus is on cash flow, just from a risk profile perspective. It's the right match for me. We were talking about the match before. That's really the right match for me. I don't want to have to worry about a development that's going 8 months over that, what's going on with it? Am I going to get the return? Like, it's for me, I really invest for that predictability, and the predictability is coming from the cash flow. So that's the way that I do it.
I like the big chunks of cash that come out of those big things, but there's a lot more stress and management headache that comes with it too. So it's just a different perspective of that aspect. And like what Warren Buffett says, diversification's for suckers, unless if you know what you're doing. So, but all these guys are suckers up here. But no, I diversify too. But in the beginning, you really need to focus on one activity and focus and get really good at that, and then start to diversify out from there in these different aspects. So
I want to clarify something, because it's I come across this a lot. Like, I don't consider myself to be diversified in the way that you're thinking. I like hyper focused on passive opportunities and learning how to weed out passive opportunities and figure out who to make a bet on. So even though I'm in 170 or 100 things, I'm not actually diversified in the way that he's talking about, which is because like a Warren Buffett or some of the most successful business people in the world focus on one thing. That's how they built their fortune. So I totally believe in that, and I just try to be the best possible passive investor I can be, which means understanding how to analyze all these things. So really, it's not. That's an important point.
You have hyper focused on the cash flow piece, which is actually important. And if you do look at the diversification piece of his portfolio, you got multiple operators, multiple states, multiple asset classes, and small amounts of cash on each one of those assets across 100 of them. You're in a pretty safe position unless there's major issues with certain asset classes that you're overly invested in.
Anyway, I'm sorry to sidetrack, because I know you're asking a question. So you guys.
Yeah, just so definitely all of the above. And just from a big picture perspective, I think it's important to build a portfolio of equity, also debt. And then within debt, I think it's a good idea to combine amortizing investments with non-amortizing investments. So a non-amortizing investment, so you invest $100,000, you get a 9% interest rate, you get $9,000 a year. With an amortizing investment, it pays itself down during the duration of the note. So you could have a $100,000 investment that pays itself down over 7 years. So instead of it being only interest only, you're going to get some of your capital back. And if you're in the process of stepping out of the corporate world, for example, having those high cash flowing assets, and correct me if I'm wrong, but if you play with a calculator, I have an idea. If you have an asset, let's say it's a 9% interest rate, and it pays itself down in 7 years, the cash on cash is going to be like 33%, something in that range. Let's just imagine that that's true. My point is, you're going to get a lot more cash flow, right? And then as far as appreciation, I think probably up here, maybe other than Matt, I'm more willing to look at more value-add focused opportunities. With self-storage in particular, there is a really unique opportunity to take advantage of significant mismanagement in those businesses. And because they are on monthly leases, and because the complexities of the asset class, you can add tremendous value very quickly to those assets. So one of the examples of this is that you can do U-Haul. So you can buy properties that are not implementing a U-Haul strategy. And then we have a relationship with a sponsor that has a great relationship with U-Haul. They buy that property, they let U-Haul park 10, 20, 40 trucks on that facility, and then rent out the trucks to the tenants as they're moving. And I have personally invested in deals where that one line item on Excel has gone from $0 a month to $3,800 a month directly to the bottom line. If you're looking at that on a cap rate basis, that's about $1 million, $700,000, something in that range of value added to that property. So when I'm looking at it on a cap rate, you could say, wow, you're buying a 3.5 cap in Fayetteville, North Carolina. Are you insane? But in 2 years, it's a 7.8 cap because of those type of strategies. There's many of them, but I'll just give you an example of one.
And I think it's important to understand, too, when he's talking about, there's pros and cons with a value add versus something that's, Jeremy likes to invest in stuff that's already cash flowing, but a slight value add, which brings less operational risk from the operator that's doing the deal. If anytime you're dealing with a major value add, unless it's a simple thing like, bringing in U-Hauls where there's no capital expenditure, you have a greater risk, a performance risk from that operator, but, you also are getting the benefit of counterbalancing any downside risk of the market by adding that much additional value to it. So I look at it as safer as long as that operator is, really, really high quality and you've invested with them and you're, they need more, you need to have more trust in them, the bigger the projects they're doing on that side of things, and they can get those deals done. So, Tuna, what about you?
Okay, I'll add real quick to answer that. So cash flow is much more important to me than capital gain. I'm not going to avoid capital gain. I really do care about appreciation. It's just that you're kind of making assumptions of the future that you're not really sure is going to happen. Cash flow helps you sleep at night. You can kind of control that. You have an idea from day one how the property is going to perform. To say a property is going to appreciate or double in value in the next few years, how do you really know? But to answer your question, I do appreciation play. That's why I'm in California. Because California is one of the best places in America that actually appreciates really well. So that's why I buy in California, but I focus on cash flow first. To answer diversification, you'll know when it's the right time to diversify when you start getting scared of losing what you have. That's the easiest way to think about it. Until then, focus and build your empire.
So we're talking about evaluating the deal based on the cash flow. And since your mortgage is going to be a big part of your expense, let's say if I put 30% down, maybe I don't have a positive cash flow. But if I put 40%, maybe I do get. So how do you evaluate based on how much equity you're willing to put into that investment? Because if you are buying 100% cash, for sure you're going to get positive. Right.
Yes. So the question, to repeat,
is the question. The question is about how much money do you put down. These guys are looking at assets where there's already a down payment, they're raising equity, versus you look at an individual property and you're having to decide how much to put down to generate your cash flow. When you were getting started, like, were you looking for a minimum cash flow and therefore would raise that amount of equity so you could cash flow it positively?
Yeah, so to answer your question, when I first started, and then now it's different. When I first started, I was doing, they forced me to do 25 and 30 and 35% down. They wouldn't let me do 20. I tried very hard, but every time I kept getting declined. So I was doing between 25 to 35. Most of it was 30%. And I try to have every property at least make $500 a month net. So that dictates whether I'm going to buy it or not. And nowadays, I take less leverage only because, like you said, the property prices have gone up. I don't want to take a lot of risk anymore. I'm more cash flow focused. And I want to be able to ride the downturn if there is any that could be coming up in the next couple of years. So a lot of times I do either 50% down, or I just buy cash.
And keep in mind, too, when you're looking at that stuff, you're looking at what your return on investment is on your down payment. So you can always put 100% down, but your return on investment may not be that high because you're not using any cheap money to finance. And so in California, it's a happy medium between big down payment and cash flow, and making sure that you put all the right numbers in there, but at the same time, making sure that your return on investment is high enough to make sense too, because you're looking at what else could you do with that money to make a higher cash flow return. So you can invest on other things. Right. So if it doesn't cash flow, then well enough for you, then don't invest in it. So we had a question over here.
I was going to ask about how the rest of you financed your first sort of investment for your first property purchase. Tuna talked about his method when he was first getting started. I was wondering about the rest of you.
So I have almost always, except for 3 properties, which I was the only owner of because they're residential properties. I have always relied on sponsors to get access to financing on the debt side. So in the type of investments I do, the sponsor will be going on the debt. They'll be personally guaranteeing the debt. They'll be using their balance sheet for the debt. So when we go to buy a $15 million property and they're looking for a $10 million loan, it isn't my E-Trade account that gets that loan, and it's not me that has to worry about whether or not there's a default, which is one of the benefits of investing. Passively, you get the benefits of relying on a sponsor in terms of their expertise and their time and their energy, but also their liability when it comes to both credit and because they have sole control over the day-to-day management. If something goes wrong, if someone dies in the property or something weird happens, it's not you, the passive investor, that has to experience that. And so, when you're building a portfolio, I think it's wise to consider implementing some of that as well.
Question here. I've been writing a list of questions, so now which one do I pick? The agreement, like the side agreement you have with that sponsor, both of you or whoever, Can you tell a little more detail what that looks like? Because how are they protected? You protected? What, because you're like the owner, but really they're on the mortgage. So I'm just kind of curious if you can talk about that.
I was going to try to just spit a fast answer out so you get all of yours done real quick. For me, it varies significantly. So in some of the opportunities I've invested in, I will create an entity in which I have an agreement with both the sponsor and the investors. So in my entity, investors will fund to our entity, and I will be the manager of that entity, and then that entity will invest in the limited partnership of their main entity in which they're the manager. They're the ones that, I hope that answers your question.
Okay, so it's more complex than we can talk about.
Oh yeah, but we can get into it later, of course.
Yeah. By the way, like these guys, like when we're done here, that's part of going over to North Italia with us. If you have more questions like this, all you guys are coming to hang and spend some time. So, all right, we've only got about maybe 5 minutes left. So let's end with this.
Let's not end with an entity flow chart of me drawing circles in the.
Please, anything but that. Let's talk about just moving forward, as investors, now that you're just kind of give a little indication of what you're looking at right now, what types of opportunities that you're interested in, and, kind of where you see things going here in the next few years.
Okay, so I am really bullish on the two asset classes that I focused on a lot. It's not because I have a business around that, and that's why I'm talking about those. I built the business around my own personal investment thesis. So I'm biased, of course, but the proof is in the pudding. I invest in each opportunity. So I am extremely bullish on those for the reasons that we've outlined before. I think that we are certainly due from an economic correction. A lot of people that I look up to are not really that hesitant in terms of the real estate specifically. So I think there will be a correction in the capital markets where it's going to affect every piece of real estate in the country like it always does. But I don't think we're going to have this crazy wild opportunity to buy when everyone's puking, to keep it short.
Perfect. Jeremy.
I currently consider it a very dangerous time to invest. The valuations are very high. I'm actually a very happy seller. I'm actually involved in about 15 different things that are selling right now, and I'm actually very happy about that. And I am just kind of sitting on the sideline looking for unique pricing on opportunities right now to make sense of something, or just waiting for an eventual correction, because it's cyclical, so it will eventually come. And for the next 10 years, I mentioned I look for predictability. So there's 4 asset classes I'm probably going to focus on the most. I'll focus on everything, but the ones that are most obvious to me for predictability for the next 10 years are apartments in general, as far as the right location and the right demand areas. Millennials have a ton of debt, having trouble buying homes because of that. I think there's going to be continued demand for apartments, as well as some retirees who are selling their homes, downsizing, living off some of that savings that are built into their homes, and then probably going to rent, whether it's a home or an apartment. I'm not saying apartments are the right thing to invest in today necessarily. Personally, I think everything's overpriced. But in the next 10 years for predictability, I like apartments. Really like mobile home parks because I think that unfortunately robots are going to displace a lot of jobs, and there's going to be stagnation of wages for the next 10 years, like there has been pretty much for the last 10 years, except for the past year or two. And so I'm definitely looking forward to more investing on the mobile home park side. Mobile home parks are actually probably the lowest turnover rate of any major commercial real estate asset class that I invest in that I can think of. So from a predictability standpoint, it's really great. Self-storage can do really well during downturns. And if you look at them in the right locations, there's a little overbuilding that takes place in that area, in that industry, because it's cheap to build and you can kind of move in and build very quickly. But in the right locations for the next 10 years, Florida is a great example. It's ironic because just literally sold about to sell the 4th self-storage property I invested in 2013 to 15 in Florida. I'm hoping to reinvest in those once there's a downturn. But Florida, just with the number one, population projected increase for the next 10 years, people are going to downsize, retire to Florida, and they're going to have to store things. So that's just another obvious example to me of what predictability of where there's going to be demand. And the 4th is senior living. Independent living, assisted living, and other types of senior living. I have yet to invest in that as well, because usually those are all development opportunities right now. Most people don't know, the demand for those is really going to pick up in 2021 and on based on all the numbers, because some of the baby boomers that are retiring are still too young to actually really demand, assisted living. They don't need that yet. But I think the next decade is going to be huge in assisted living, and as far as demand. And you got to watch out too, because there's definitely overbuilding in that sector as well, because people see what's going on. But I think from a predictability of demand for the next 10 years in the right locations for the right types, private pay. Public pay is not predictable. Like, what will the government be able to afford to pay on behalf of a tenant in 10 years? I don't know. But private pay is interesting and is also predictable. So those are the things that I'm focused on, and also really trying to sort out how all these other technologies are going to impact real estate continuing to go forward, which is because it's really tough to predict.
And blockchain and all these other technologies are going to change the whole game. So, your ability to be successful is going to be dependent on your ability to stick and move when things change. So, and keep your eyes open for those opportunities, because there's going to be a lot of them, which is pretty cool. Tuna, what do you think about what's going to happen? When's it going to crash? What's the date?
I'm the last person to ask. Obviously, they're all smarter than I am. I want to backtrack a little bit. So 10 years ago, I told you guys a story that I was about to move back home because my business was about to fail. 2 years prior to that was 2006. That's actually when I started learning real estate, at the height of the market. So if you think this is the height of the market or whatever, it doesn't matter. Take the time to learn it now. I didn't buy anything back in 2006, thank goodness. But that's actually where my real estate education began. So right now what I'm doing is I'm just stacking up a bunch of cash. Like, I'm literally stacking money, because you get opportunities like this once every decade. So like the time that I first started was like 2010, whatever. It's going to happen again. May not be as significant as last time, may not be the best deals as last time. I just need good, okay deals. So I'm stacking a lot of cash. I'm trying to increase my income as much as possible in the next few years. I'm trying to stack it, wait for the downturn, and attack. Like, I'm literally going to double in onto this next downturn. The downturn will happen, guys. If you think about the longest expansion in history, we're almost there. We're about to be the longest expansion in history in the United States by next year. By next summer, we'll be the longest. That's like unheard of. So we are going to have a downturn. When that's going to happen, who cares? At this point in time, work on yourself. Go on Zillow, it's free. Stack cash, save money. Work on things. Start borrowing money or start raising money right now. Don't wait. Learn real estate today. Try to buy today if you can. I'm buying today. Even though I know there's a recession or whatever that may come, I'm being very smart about how I'm buying. That's why I'm trying to keep my leverage very low so I can ride the downturn. So.
Cool. Well, before we go to North Italia, I got one final question. Jeremy, can you please show the audience how low you got on the dance floor in Vegas? It'd be awesome, dude. We really need to see that. Like,
I'm sorry, but I'm wearing the wrong clothes. So.
He was literally down here. I was so impressed.
He was wearing the wrong clothes then too, I think.
and yeah, probably, yeah. And Hunter, for some reason, at the club in Vegas, had a pizza box like this out of the blue on the dance floor.
I didn't have it delivered. I didn't have it delivered to the club. They had given them out.
I was like,
they had given
amazing.
Them
out. So, but anyway, so. What was the question?
Dave was at church, actually.
Yeah, we don't know what happened with Dave. Like, he went to sleep at 10:30. You know, that's pretty much what it was. So, but yeah. And then Tuna, I got to make fun of him, and he brought his girlfriend today. So I got to show all the Asian white baby pictures of me and my wife, so that way I can make fun of him. It's just
stay single,
awesome.
save money.
Now it's time to go.
There you go. All right, thank you guys. Feel free to go over to North Italia. If you go out the back door right here and down the stairs, it'll pull you out right on the edge of North Italia. Just walk down a little bit.
Right. Also, first of all, hey, can we get a round of applause for these guys?
Thanks, guys.